in March 2008, Bear Stearns failed. Then in June, July 2008, Fannie Mae and Freddie Mac collapsed. September 2008, Lehman Brothers collapsed. Morgan Stanley would have been next, then Goldman Sachs, then Citibank, Bank of America, finally JP Morgan. They all would have fallen like a row of dominoes. When the earthquake started in 2007, 2008, the Fed truncated the process, but all they did was store up the energy for a future financial crisis.
Every gold investor should consider top quality assets partnered with the best in the business, a real portfolio to profit. Gold year to date is up 22%. However, a portfolio that is positioned correctly should be up 155% this year. To learn more about how you can begin to enjoy the bull market in gold, visit crushthestreet.com/fortune.
Hello, everyone, and welcome into crushthestreet.com. We have a returning guest, popular James Rickards, and he's got a brand new book out, The Road to Ruin, the Global Elite Secret Plan for the Next Financial Crisis, which, of course, we're going to talk about today, being released November 15th. He's a best-selling author. Of course, you know the new case for gold, the death of money, currency wars. He's the editor of Strategic Intelligence. He's a lawyer, financial expert. He's got hedge fund experience. The list goes on and on. James Rickards, thanks for joining me today.
Ken, thank you. Great to be with you.
Of course. James, I want to discuss your book today, and by discussing the economy, markets, and the election, you discuss bailouts and the crisis, and these crises in your book, and how each one of these crises over the last 20 years or so were sidestepped by bailouts and escalating bailouts at that. So I'd like you to discuss this with our audience here today, kind of give us a history and a little bit about what the book is about here.
Sure, I'd be happy to. So it's my new book is called The Road to Ruin. It's coming out November 15th, but it's available for pre-order on Amazon and Barnes & Noble right now. And what it talks about several things. Obviously, the coming financial crisis, but what it really does, it puts you in the crisis and shows you how the elites, how the international monetary elites will handle it, how they'll react to it, and what the impact will be on individual investors. And to do this, I set up a tempo of 3 financial crises. I start with 1998. Of course, that was the Russian default and collapse of the hedge fund long-term capital management. I come forward 10 years to 2008. That was the mortgage crisis and the global financial panic, liquidity crisis that followed that. And then come forward another 10 years to 2018. And I hypothesize a financial meltdown in 2018, but make the point that it could be tomorrow. In other words, 2018 is a reasonable estimate, but it doesn't mean, we wake up January 1st, 2018, and everything falls apart like clockwork. It's more just to give an order of magnitude, a potential time frame, but it is something that could happen tomorrow. In going through those crises and talking about 1998, by the way, I negotiated that bailout. I was the lawyer for long-term capital management. I was in the room with the officials from the Federal Reserve and the Treasury and the big banks and a ton of lawyers when we did that bailout, so I had a front row seat. And we were just hours away from the collapse or closing of every stock and bond market in the world. That's not an exaggeration. Alan Greenspan, chairman of the Fed at the time, Bob Rubin, secretary of the Treasury, testified to the depth and seriousness of that crisis before Congress. And as I say, I saw it happen, and I knew what was going to happen next if we didn't get that. It was turned out to be $4 billion that was collected by Wall Street and put in to prop up the balance sheet of long-term capital. Come ahead to 2008, same thing. We were just days away from the sequential collapse of every bank in the world. It had started, in March 2008. Bear Stearns failed. Then in June, July 2008, Fannie Mae and Freddie Mac collapsed. September 2008, Lehman Brothers collapsed. Morgan Stanley would have been next, then Goldman Sachs, then Citibank, Bank of America, finally J.P. Morgan, they all would have fallen like a row of dominoes. That didn't happen, and it didn't happen because the Fed truncated the process. And here I make the distinction between natural systems and man-made systems, which are all complex dynamic systems. The dynamics are the same, the math is the same, they operate the same way, with one important difference. In a natural complex system, and you could use a seismic zone or volcanoes or forest fires or climate or hurricanes or a lot of other phenomena, but let's just take seismic activity for a minute. What is an earthquake? Well, an earthquake is a release of energy. When an earthquake starts, you can't stop it. The energy has to be released, and then it settles, and then it's over. But you can't stop an earthquake in the middle. But imagine, hypothetically, as a thought experiment, if you could, all that would happen is the energy would not be released, but it would be stored up for a future earthquake, which would be even bigger than the one you tried to stop, because new stresses would emerge, but that old stored up energy would still be there. It's the same thing in capital markets. When the earthquake started in 2007, 2008, the Fed truncated the process, but all they did was store up the energy for a future financial crisis. So how did the Fed do this? How did they stop the earthquake, if you will, in 2008? Well, it was massive money printing, and not just the $4 trillion we see on the Fed's balance sheet today. I mean, over the last 7 years, they took their balance sheet from about $800 billion to $4.2 trillion, and it's still close to that level. But that's just the tip of the iceberg. They did $10 trillion of swaps with the European Central Bank at the time. What was going on there is the European banks loaned money in dollars. They had to borrow dollars to fund those loans. The borrowings came from U.S. money market funds to a great extent, which were investing in euro dollar CDs and short-term commercial paper. So there was a panic in the United States. U.S. citizens were pulling their money out of the money market funds. Money market funds couldn't roll over the European paper, so the European banks their dollar funding was drying up, so they turned to their lender of last resort, which was the European Central Bank. But there was a problem. The European Central Bank can print euros, but it cannot print dollars, and those banks needed dollars. So what happened was the European Central Bank printed up tens of trillions of euros. The Fed printed up tens of trillions of dollars. They swapped. So the ECB got the dollars, the Fed has the euros, and still has some, by the way. And then that's how the European Central Bank basically bailed out the European banking system with dollars from the Fed. The Fed and the FDIC and other regulators guaranteed every bank deposit in America, regardless of size. They guaranteed every money market fund in the United States, which they had no legal requirement to do. The point is, massive guarantees, money printing swaps, liquidity provisions, all designed to stop that panic. And it worked, but the problem is that no problems were solved. The biggest banks are bigger, their derivatives books are larger, they have a larger percentage of the total banking assets today, and most importantly, the Fed has not normalized its balance sheet. So, for example, the Fed took their balance sheet, as I mentioned, from $800 billion to $4 trillion or more to deal with the last crisis. If in the past few years they had managed to get the balance sheet back down to, say, $800 billion, maybe even $1 trillion, and get interest rates up to 2.5%, 3%, and those normal balance sheet, normal interest rates, I'd be the first one to say, congratulations, guys, you did it. You saved the world, and you got your balance sheet back to normal. But that didn't happen. The balance sheet is still at $4 trillion. Interest rates are still close to zero. The Federal Reserve and the other major central banks in the world have no scope left, no headroom, or no dry powder to deal with the next crisis. And so come forward to 2018, but just look at the last two. So in 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. In 2018, if not sooner, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before. Each bailout has to get bigger than the one before. In the next crisis, it's going to be bigger than the ability of the central banks to deal with it. The only source of liquidity, the only clean balance sheet left in the world is the International Monetary Fund. And they will print trillions of special drawing rights or SDRs. That's world money. That's the IMF is a printing press. They can't print dollars, but they can print these SDRs and hand them out, and they will. And that will be where the liquidity comes in the next crisis. But of course, that will mean the end of the dollar as the benchmark global reserve currency.
Mm-hmm. Well, and I was going to ask you about the dollar then, and just to explain that a little more, because if the next crisis is going to be averted by the IMF, which it will use the SDR, and that will be power that's taken away from the U.S. dollar, and how significant do you think this will be for the U.S. dollar, and what will the consequences be?
Well, it'll be very significant. The main consequence will be inflation. Central banks for the last 8 years have been trying to get inflation, trying to cause inflation, and they haven't succeeded. I like to say it's a sad day when the central bank wants inflation and can't get it, but that's exactly the situation we're in. But the major sovereign debt issuers, the United States, China, Japan, all of them have very high debt to GDP ratios. They're on a non-sustainable path. Their debt to GDP ratios are increasing. Their situation is getting worse. None of them have a way out. There's no feasible combination of higher taxes or growth that's going to make the debt sustainable. So the only way to make the debt go away is we can just default on it, but there's no need to do that, because why would you default on debt if you can just print the money? But the other way is inflation, where you pay off the debt in nominal terms with printed money, but the money's not worth very much. So that's what they would like to do. They have not been getting it so far, mainly because all the money they've been printing has not been spent. People are not borrowing the money. They're not spending the money. We're not getting the velocity of money that you need to actually cause the inflation. But with this SDR issuance that we talked about coming from the IMF, that's not walking around money. You and I won't have any. They don't give SDRs to individuals. They give it to countries, and those countries can be relied upon to spend it. They will, in fact, spend it. And by the way, the IMF is not limited to giving SDRs to its member nations. They can give it to multilateral institutions such as the United Nations and the World Bank, and they will. They'll give the World Bank SDRs, and the World Bank will spend it on climate change infrastructure. This has already been announced, and it's important, Ken, that everything I discuss in the book is backed up. There are 151 endnotes, lots of sources, direct quotations, working papers, resources for the readers to look at. But the point being, it's all out there. It's all backed up, and I explain it all carefully in The Road to Ruin. But the consequence of this will be money printing of an unprecedented scale coming from someone that's not a country, that will definitely be spent because it's going to be given to countries with an agenda. And finally, that will cause the inflation. The only safe havens will really be hard assets such as gold, silver, fine art, income-producing land, maybe some forms of private equity, natural resources, water, oil. Those things will last, but any paper claims, insurance, annuities, retirement funds, even the stock market will evaporate under the force of inflation.
Well, I want to talk to you about the IMF inclusion of the yuan. We certainly know this was a blow to the U.S. dollar. And a lot of us were anticipating, what gold would do on this news. But it seemed like at least when the news came out, that gold seemed to brush it off. And I just want to get your thoughts on what is going on with that and, gold for that matter.
Well, gold will be going much higher under either one of two scenarios. So let's go back to this end game that we talked about with the next crisis and the massive issuance of SDR. So one of two things will happen. Either the SDR gambit will work, and if it works, it'll probably be because so few people understand it. This is fairly technical stuff after all. That the inflation will come, no one will quite know where it came from. There'll be no accountability at the IMF level. IMF's not a country. We'll just end up with the inflation, but no one will quite know who to blame. In that scenario, gold will go up because it always does in inflation. Gold doesn't really go up, by the way. The dollar price goes up, but what's happening, of course, is the dollar is going down. So if gold goes from today $1,300 an ounce up to $10,000 an ounce, which is what I expect, you can call it a big gain for gold, but I really view it as the dollar going down 80%. In other words, it takes 5 times as many dollars to buy an ounce of gold. But let's say it doesn't work, that people see through it and they say, look, we've lost confidence in all these other kinds of money. Why should we have any more confidence in SDRs? In fact, we don't, in which case the global elites may have to go to a gold standard of some kind, not because they want to, but because they have to restore confidence. There's not a central bank in the world that wants a gold standard, but as I say, if it's the only way of restoring confidence and getting the international monetary system moving again, they will go to a gold standard. But if you do that, the price has to be $10,000 an ounce or higher. That's a very straightforward analysis. It's not a number that's made up or a pull out of the air. There are the combined M1 money supply of Japan, Europe, the United States, and China today is $24 trillion. There are 33,000 tons of official gold in the world. So if you take the 24 trillion, assume 40% gold backing, and that's an assumption. You could say I want it to be higher or lower, but 40% is what the United States required between 1913 and 1968. So, and it works. So that's the number I'm using. So 40% of 24 trillion is 9.6 trillion. You need $9.6 trillion dollars worth of gold. You have 33,000 tons. Divide one by the other, and it comes out to over $8,000 an ounce. And of course, M1's a moving target, so by the time this all happens, it'll probably be closer to $10,000 an ounce. So if you have a lower price than that, you're going to have to reduce the money supply to make the parity work, and that will be highly deflationary. You'll be repeating the blunders of 1925, and so as I said, monetary experts and scholars will understand this. This is basic economic history, basic monetary policy. So you're going to have to make gold $10,000 an ounce or higher to have a gold standard. So either gold goes up because you're on an SDR standard and it's inflationary, or gold goes up because you have to go to a gold standard and you have to avoid deflation to get the price right. But either way, gold's going a lot higher. In the short run, sure, it'll fluctuate, it could go down a little, but it's going to go much, much higher sooner than later.
Yeah, no, I couldn't agree with you more. Jim, when it comes to the election here, the more Hillary Clinton gets investigated, it seems like the more the markets drop, and gold is actually spiking. We're seeing a move up in gold and silver. And I'll just ask you this. Do you think the market is a Democrat in this situation?
Well, I don't think the market's a Democrat or Republican, but it does try to discount future events. And what was happening is that until literally the last couple of days, there was a very powerful consensus that Hillary Clinton was a sure thing. And this was reflected in the stock market, in the price of gold, but pundits, betting odds, polls, elsewhere, everywhere you looked. There was one online betting service in Europe that was actually paying out Hillary Clinton bets. If you had bet that Hillary Clinton would be president, you could take your ticket in, and they would pay you as if you were winner, as if the election was already over. People were talking about, Hillary was picking her cabinet, shaping her first 100 days. So the markets were completely priced for Hillary Clinton. And I was actually in Australia last week, and even before the FBI revelations on Friday, October 28th, this was actually a couple days earlier, on October 25th, I did an interview on Australian television. I said I thought Trump would win, but this was an unbelievable trading opportunity, because when the markets are fully priced for a certain outcome, such as Clinton's victory, you have an asymmetric trading opportunity, which means if you do a trade that will make money if, say, Trump wins, it's sort of heads I win, tails I don't lose. In other words, if you shorted stocks and went long gold, for example, and then Clinton wins, you wouldn't lose any money, because the stock market's not going to go up because it's already priced for that. Gold's not going to go down because it's already priced for that. But if Trump wins, stocks will crash and gold will go up $100 an ounce or more, because the markets have to very suddenly and violently reprice for the unexpected outcome. So you have this trading opportunity where you're not going to lose money if Hillary wins, but you're going to make a lot of money if Trump wins. So that was the setup. What happened, of course, Friday with the revelations is that suddenly the market began to have second thoughts. They said, maybe this guy Trump could win after all, and started repricing, not kind of instantaneously in the violent way that I was expecting on election day, but gradually over a few days as the realization started to sink in. So you've seen stocks go down, and you've seen gold go up. Now, it has not fully repriced for a Trump victory. All it has done is move a little bit in that direction. I still my view that Trump will win, and that those market trends have a lot further to go. So my expectation, and we'll see what happens. I think it'll be a close election no matter what, but my expectation is that Trump will win and gold will go up. At this point, I was saying $100 an ounce, maybe $50 or $60 an ounce, because it already went up about $40 in the last couple of days. But I would see gold spiking up and then staying there. It'll kind of reach a new plateau and then kind of go from there. And by the way, Donald Trump is the first presidential candidate since major party nominee since Ronald Reagan to speak favorably about gold. He has not called for a strict gold standard, but he said, it's something worth thinking about, worth looking at, and I think that will give gold a lift and keep it there.
Yeah. Well, I tend to like Donald Trump, and it's unfortunate that the market is going to have that correction if he does become the president, because of course that's going to, for people who aren't in the know, it's just going to look really bad for someone who's a little more free market and wants to shake up the establishment a bit. I want to get your thoughts here. If we do see a Clinton victory, interestingly enough, I'm almost wondering if she'll let the whole thing crash right away, if she can cause that to happen, rather than the bubble bursting 4 or 6 or 7 years into her presidency, because then, at least if it happens now, she can blame it on Obama, but if it happens down the line, then it's completely in her lap.
Well, I'm not sure it's in her hands. I think the Fed has a much more important role to play there, but you make a good point in the sense that it has been almost 8 years, kind of 7.5 years since the end of the last recession. We've had a 7-year plus expansion, 88 months at this point, far longer than, almost twice as long as the average expansion since the end of World War II, and long even by the standards of the post-1980 period, which was, characterized by very long expansion. So this is quite a long expansion. The idea that we're going to make it 7 more years without a recession, that's almost impossible. It's not literally impossible, but practically, I would expect a recession, maybe even in 2017. We may even be in one now. We just don't know it. But the thing that's going to trigger that is not a Hillary Clinton victory, but rather the Federal Reserve raising interest rates in December, which they will do. And remember what happened last time they raised interest rates in December 2015. The stock market fell 11% in the following 8 weeks. So we could see a replay of that, and stocks could go down, and that could spin out of control and cause financial contagion and spillover effects, not because of her, but because of the Fed. By the way, I think the Fed, I'm almost certain the Fed will raise interest rates in December regardless of who wins, whether it's Trump or Hillary.
Interesting. Well, there you have it, everyone. James Rickards, and he's got his brand new book, The Road to Ruin. Be sure to pick one up. We'll have the link in the description area. James, any final parting words for the audience before we say goodbye?
Just look out for volatility. I think the main advice I could give is, I'm talking about a future crisis, and I talk about how to prepare for it, but don't wait. Get prepared today. When this crisis hits, it'll come very quickly. No one's going to know the exact time. You can see it coming. You can estimate the magnitude of it, but you won't know the exact time. But when it hits, it will hit quickly. And people who think, oh, gee, I'll wait till it hits and I'll sell my stocks and buy gold. No, you're not going to have time. The stock market's going to be crashing. Physical gold will be unavailable. It'll be a very short supply. You won't be able to get any. So the time to make those preparations is now.
Well, thanks so much, sir, for that, and good luck to you on this new release.
Thank you.